Welcome, everyone, and thank you for joining us today for this update from our investment team. My name is Emerson Savage, Director of Institutional Investor Services here at Lewisburg Investments. I'm joined by Mathieu Edouard, who is our head of equities, and Heather Hirschman, who is our head of fixed income. As you all very likely know, 2020 was an unprecedented year, due in large part to the coronavirus that became readily apparent in the first quarter of 2020 and had a very significant impact on financial markets. So with that, I'll turn to you first, Matt. What was so different about 2020 relative to other volatile periods we've seen in the
past? Well, it was a remarkable year on all fronts. Personally, from a business standpoint, Zoom meetings, be locked up in our houses, and we're still doing that. But it was also a remarkable year from an investment perspective. And to me, two moments or years stand out in my investment career, and it's 08, 09, and 2020. If you look at it today, really we've had a big recovery by financial markets and by equities, but economic and business conditions haven't improved all that much. I mean, we've put the things in place to help ourselves within the recovery, but businesses are still closing and less profits. So from that perspective, we're just doing the right things. From an investment conditions standpoint, they've improved a whole lot, and that's what equity markets are responding to because they're forward-looking. So they're not thinking about 2020 profits; they're thinking about 2021 and so on. And the difference when I bring up 2008 and 2009 versus today was central banks and the governments were a lot quicker to react, and they reacted in a significant way. They did a lot of things that helped reduce the risk for investors, for companies, and in turn, that increased the appetite for risk assets, essentially helping investors feel comfortable buying equities and helping the financial markets improve. That's the big difference with 08, 09, and that's what a spectacular year in terms of how quickly we went down and how quickly we've recovered and surpassed those previous highs.
Thanks for that, Matt. And now, Heather, perhaps through more of a fixed income lens, how was 2020 a different year?
Thanks, Emerson. So I agree. 2020 was unprecedented in terms of market conditions. Unlike other periods of market volatility, the events of 2020 were caused by an extraneous event, which very quickly became a global viral pandemic that spread to the fabric of economies due to the economic shutdowns that ensued. So as a result, the response by both governments and central banks around the world was very quick. And that is unique in that it isn't targeted to a specific sector or area of concern. And that has created very unique conditions in both fixed income and equity markets. Those conditions are very supportive monetary and fiscal policy environment currently that has been created. So the events the cause is unique, the response and the speed of the response is unique. And the outlook as well is one that addresses the interruption in economic activity, but there is a high degree of unknowns going forward in terms of the fundamentals and the underlying growth trajectory of the economy given this development. So we do have a degree of unknowns, but we have a supportive environment through intervention.
Thank you for that, Heather. I think we've taken a really nice backward look at the year that was 2020. So given the events that transpired in 2020, Matt, I'll turn to you first. How does that position us going forward for 2021, and what is the current investment landscape?
Sure. So looking at 2021, we turn the page on the calendar, but really nothing really changes. Those conditions remain. There's a lot of support by governments and central banks. Central banks in particular are signaling that they're prepared to stay low for long in terms of interest rates, and governments are trying to put in a lot of fiscal stimulus everything about that is positive for equities. So lots of support. You're looking at investors; they're very positive as well in terms of their behavior. Maybe too positive. We've seen a lot of retail investors take a lot of risk in 2020. I think that's had some influence in terms of the market. There's been some big changes in terms of how people do things. That's created some themes. Maybe created some mini bubbles as well. So a lot of positives. Sentiment is positive. That creates risk, because as we discussed earlier, profits were down in 2020, but markets were up. That means that multiples have moved higher, and investors are looking a little into the future in terms of what the earning power should be. So we are borrowing a little bit from future returns, as we've seen the earnings multiple expand. That doesn't mean that equities will be a poor investment over the next few years, but maybe what that does mean is that you keep your expectations a little lower in terms of what the average return you should get from equities over the midterm. Longer term, they've always been the best investment class, and if you look at its competition today, I call it the TINA. There is no alternative. They still seem like a good choice. Buffett says when people are fearful, be greedy, and when people are greedy, be fearful. I think we're not at any of those extremes. I think you should have a average amount of equities in your portfolio, but you should not be using leverage or being aggressive with your allocation. The other element that's important is selection is key. I mean, we can always say that, but if you look at the last few years, it's been a narrow market, a lot of focus on technology. We mentioned those retail investors. They've created some mini bubbles in certain sectors and or subsectors. So when we're building our equity portfolios, we're emphasizing selection. I think you're getting a lot of attractive investment choices in this environment I'm talking about. However, consumer staples stands out. A lot of attractive businesses with solid fundamentals, which have actually improved in 2020. But because the market is so focused on cyclicals, you're able to buy those businesses at very attractive prices. So a lot of safety there, I find, and some long-term value. And there's other elements where if you're looking at the themes in the market, there's anti-themes as well. So, you think about retail real estate or office real estate. Certainly, it's soured the sentiment in general on real estate, but there's some opportunities there as well. You're seeing some apartment REITs come up for sale. You're seeing some businesses that cater to the real estate industry that should continue to thrive, like Colliers, which we've been able to add to the portfolio. Or there's also a lot of attractive opportunities. So the key is be measured with your equity exposure, 2021 and going forward, but also be mindful of what type of companies that you're buying in terms of safety and getting paid for the risk that you do decide to take.
For that, Matt. And Heather, I'll turn to you on the other side of the coin by fixed income. Given how 2020 progressed, how does that position us for 2021, and what is the current landscape of fixed income?
Yeah, so in 2021, the fixed income markets have started to now focus on the longer term outcomes and the recovery and the reflation of the economy. So in 2020, rates remained low even in the long end. And going into January of 2021, the curve has steepened. Also, credit spreads have tightened with the reach for yield intensifying as rates remain low and the outlook continues to remain supportive for fixed income investors with a low rate environment. So the reach for yield has resulted in a dramatic performance in corporate bonds, particularly in long corporate bonds, which are at all-time tight levels. Going forward, I think that with the tightening in spreads, that we will continue to look for opportunities where we are getting paid for taking on risk, and risk either in terms of credit risk or interest rate risk. So in times when the curve starts to steepen, we would look for opportunity to add yield to the portfolio. And in the credit space, both provincials and corporate bonds, we would focus in that 5 to 10 year portion of the curve where we are getting significant added yield over the Canada yield, but at the same time, staying in high quality credits with good risk reward metrics to them.
Fantastic. Thank you for that commentary, both of you, Mathieu and Heather. So that does conclude our review of the year 2020, as well as some of our expectations going forward. I want to thank you for taking the time to view this video. We wish you a great 2021 with ongoing health and safety of you and those around you. Thank you again.
Thank you.